All right, let's jump right in. In this explainer, we're taking a strict, no-bluff approach to building a fundamental financial mindset. Most people spend years, sometimes literally decades, frantically hunting for the perfect investment. They pore over market data, they watch endless analysis, and they hold their capital in reserve, basically waiting for some imaginary perfect alignment of financial conditions. They're entirely convinced that real wealth is unlocked solely through making perfect choices.
So, the first great illusion we fall for is the search for the perfect stock. People spend immense amounts of energy trying to find that one hidden gem, right? That one company that's going to multiply their money overnight. They genuinely believe that if they aren't picking the absolute best performer in the entire market, they're somehow failing.
And, if it isn't individual stocks, it's the endless search for the perfect mutual fund. We obsess over fractions of a percent in past returns. We compare list after list of funds, completely paralyzed by the fear of choosing the second best option. So what do? We wait. We wait, hoping a clearer, more flawless choice will suddenly emerge.
But then comes the ultimate illusion, waiting for the perfect market crash. It's this idea that you're going to brilliantly time your entry right at the absolute bottom of a dip. People hold onto their cash, watching the market rise, totally convinced a major correction is just around the corner. But here's the catch. While they're searching for this perfect opportunity and the perfect entry price, they completely ignore the one true variable that actually dictates wealth. They ignore time. Now, as we explore these concepts, and just a quick reminder, this is strictly for educational purposes, not financial advice, I want you to really sit with a specific thought for a moment. The best investor is often not the smartest. It's the person who started first. That right there is the core premise we're unpacking today. Wealth creation isn't about raw intelligence. It's not about flawless predictions or stock picking. Fundamentally, it is about time. Let's look at the psychology of delay. These are the classic excuses we tell ourselves. I'll start investing next year, or I'll invest right after my promotion. I'll start once my salary increases, or the classic, I'll just wait for the market correction. What's really fascinating about every single one of these statements is that they sound entirely reasonable, don't they? They sound responsible, prudent even, but in reality, they mask a devastating financial error. The harsh reality of finance is that the market is entirely indifferent to your intentions. It doesn't care that you plan to invest more later when you get a raise. It absolutely does not reward the money you intended to invest. It only rewards active participation. Every single year you spend waiting for that perfect moment is a year that compounding simply cannot work for you. Your money is just stagnant.
Let's ground this in a scenario to see how this builds into something profound. I want to introduce you to two completely hypothetical investors. We are setting up perfectly identical financial parameters for both of them. Person A starts investing at age 25. Person B starts at age 35. Everything else? Exactly the same. Both are investing exactly 5,000 rupees every single month, both earn exactly a 12% annual return, and both stop investing at age 65. The only variable separating them is a 10-year gap. Let's see what actually happens.
Listen closely to these numbers. Person A, starting at 25, invests for 40 years. Their total out-of-pocket investment over that time is 24 lakh rupees. Their final corpus at age 65, approximately 5.9 crore rupees. Now, let's look at person B. Starting at 35, they invest for 30 years. Their total out-of-pocket investment is 18 lakh rupees. Their final corpus, approximately 1.76 crore. Just take a second to let that math sink in. They invested in the exact same way, at the exact same rate.
The difference is more than 4 crore rupees. That is an absolute gut punch. By simply waiting 10 years to start, person B lost out on over 4 crore. This massive disparity completely isolates the heavy, invisible cost of waiting. It wasn't about the amount of effort they put in. It wasn't about the quality of their fund choices.
The crucial point here is stark. The difference wasn't the return. The difference was time. And I want to be very clear about this. Person B did not make a bad investment. Person B didn't lose their money in a massive market crash, and they certainly didn't choose the wrong mutual fund. They did everything right, except for one thing. They simply started a decade later. This brilliantly illustrates why that delay is so devastating. It's the invisible mechanics of compounding. Most of us drastically underestimate this because, honestly, compounding acts incredibly slow in the beginning. During that first decade, the growth feels boring. Your portfolio barely moves, nothing really feels exciting. But then, as you move into the middle and later years, something magical happens. The returns begin generating more returns.
Compounding starts compounding itself, and the growth accelerates exponentially. So that first decade feels painfully slow, but the later decades, they do the heavy lifting.
Which brings us to a really critical question. When you make the decision to wait, what does waiting 10 years actually cost you? We naturally tend to think the cost is just the money we didn't put into the account, like in our previous example, the 6 lakh rupee difference in principal. But as we just saw with that 4 crore gap, that perception is dangerously flawed.
We have to reframe this using a concept most people never deeply consider: opportunity cost. In finance, every single decision has 2 costs. There's the money you actually spend, and then there's the future wealth you give up. When you delay investing for a decade, the loss isn't just your monthly contribution. The true opportunity cost is the heavy, irreversible loss of the wealth that your money could have created over decades. Because of how compounding works, your earliest years carry the absolute highest value.
And this directly explains why chasing perfection is a massive trap. Investors will literally spend countless hours agonizing over a 10% versus a 12% return, or a 12% versus a 14% return. They are entirely paralyzed by the paradox of choice. Which fund is better? Which stock is better? What strategy is the absolute best? But imagine spending 5 years rigorously researching investments, only to earn a 0% return because you never actually pulled the trigger and started. That paralysis is a far bigger mistake than picking a good fund instead of a perfect one.
Which leads us to this inescapable truth. A good investment started today usually beats a perfect investment started years later. The raw, decisive action of just starting heavily outweighs the endless optimization of your investment choices. Compounding rewards the years you started. It absolutely does not reward the years you wished you had started while you were busy optimizing. So, let's break down the ultimate third rule of money. First, returns grow money. Yes, the percentage absolutely matters. But second, time grows returns. Time is the multiplier that takes linear growth and makes it exponential. And third, together they create wealth. You simply cannot have massive wealth creation at the end without the foundational block of time at the beginning. The investor who starts early will almost always beat the investor who starts late but happens to know more.
So we end with a stark personal choice. The mathematics are completely clear. The cost of delay is enormous. Most people out there will spend years frantically looking for the perfect investment, convinced that making the right choice is what builds wealth. But the people who actually build wealth, they spend those years invested. So will you spend years looking, or will you spend years invested? The choice and the time is yours.